Good evening, everyone, and welcome back to the Business of Aesthetics Expert Panel. Today's topic is busy isn't profitable. Why many aesthetic practices stall at the same revenue level and the CFO framework that breaks it. I'm your host for the session, Dan Disha. It's my pleasure to have you all here. Now, we are here to examine a problem that many owners know very well. The calendar is full, the team is active, revenue looks respectable, and yet the owner is working harder without feeling meaningful, more profitable. So tonight we are going underneath the top line number to find the actual constraint. A few quick housekeeping notes before we do begin. First up, yes, we are recording, and you will receive a replay link after the session. However, do not let that make you passive. The real value is happening live. Use that Q&A button for any specific questions you may have for the panelists, or you can use the chat for conversations, reactions, and takeaways. I have my eye on both the feeds throughout the hour and will do my best to weave in your thoughts and concerns as we go along. If there are any specific questions, we might just address them in the dedicated Ask Me Anything session a little bit towards the end of our event. Right. So tonight's panel is proudly sponsored by Eco Marketing, founded by Naren Arulraja, the very same entrepreneur who co-founded the Business of Aesthetics community. Now, Equa supports healthcare practices through SEO and visibility, conversion-focused websites, and content and social authority. For over 15 years, they have served practices across the USA, Canada, and the UK. Our process notes also, okay. Uh, right. And we will be hearing more from Equa a little later in the program. Let's get to meet our panelists and then into our discussion. So first up, we have Shannon K. Weinstein, CPA, president of Keep What You Earn Co. So Shannon is a fractional CFO and financial strategist who helps medical aesthetic practices improve profitability, strengthen their financial systems, and scale with confidence. She brings more than 15 years of experience across Big Four accounting and corporate finance, and her gift is making the complex numbers practical enough for an owner to use in the very next decision. Shannon, welcome to the expert panel.
Thank you.
Was that introduction sufficient, Shannon?
Of course, yes.
Okay, amazing. Right. Then next up, we have Brooks Lowry. Brooks is the CEO of Biosynergy Labs and founder of BSL Consulting. Brooks has spent more than 2 decades inside medical aesthetics, from early works with Fraxel to senior leadership roles at Allergan and BTL, and now advising practices on mechanics that create real revenue. His expertise spans patient flow, consultations, treatment plans, conversions, major equipment purchases, finance structures, and device utilizations. Brooks, it's great to have you with us.
Well, thank you so much for having me. I really appreciate it.
Absolutely. Right. The next up, we have Javier Ibanez, founder and managing director of Market Go Life Sciences. Javier is an international commercial executive with more than 25 years of experience across pharmaceutical, medtech, regulated healthcare environments, and he has led P&L responsibilities across Europe and Latin America, transformed fragmented markets into structured commercial operations, and scaled international revenue from 3 million to 60 million across more than 70 markets. Javier, welcome to the panel.
Thank you, Tom. My pleasure.
Absolutely. It's a pleasure of ours to have you here. And then we have Andrew Goldfein rounding out the panel here, Vice President of New Partnerships at Alpha Aesthetics Partners. Andrew works with aesthetic practice owners across the country at every stage of growth and has deep experience identifying what helps a practice move beyond its current ceiling. Before Alpha, he led M&A and new site growth at Affordable Care, and earlier in his career, he worked in healthcare investment banking at Julian Loki. Andrew brings a clear view of what investors, partners, and high-performing operators look for beneath the top-line number. Andrew, welcome to the Business of Aesthetics webinar.
Yeah, thanks for having me, Don and Brooks, Javier, Shannon. Great to meet you. Looking forward to the discussion.
Absolutely. Right then, I'm going to stop sharing the screen here. And before we do get into the discussion, I have a quick poll that I would like to run everyone. Here we are. Just to get a quick read on the room. Here we go. This is the one. So I'm launching a quick poll here. The question is, which constraint feels most responsible for keeping your practice busy but financially flat? The first option is revenue is growing, but margins and owner take home are not. Option B, provider team or device capacity is being used poorly, so bad utilization. Option C, consultations happen, but too few convert or return. So there's a conversion issue in the consultation. Option D, the right clients are not finding or choosing us consistently. There's a visibility gap there. Or, of course, there's always that option where you're not really sure about what is the number one problem that is keeping your practice financially flat. Go ahead and poll in. We already have a couple of votes here, and what has happened is we have an equal number of votes across the board for a lot of these problems, right? Which is great because that's exactly the thing that we are going to be discussing over the next 50 minutes. Okay, but now we have a little bit of consultations are happening, but too few convert or return with the I don't know following up for sure. All right, I'm going to stop the poll in 3 seconds. 3, 2, 1. Share the results with our panelists here. So it seems that revenue growing, margins and owner take homes are not, with the consultation conversions, as well as not being just unsure about what is the biggest problem, being the top issues, with the right clients not finding or choosing you consistently, just following up right there. And for those who selected that option, please do hang around because we have a fantastic resource that will fix that problem, or at least get the conversation started in the right direction. With that being said, thank you very much for polling in, everyone, because you're in the right place. Keep it going, keep the energy going during the discussion. If you have any things that you want to ask the panelists, like I mentioned earlier, or any things that need further elaboration, please feel free to ask us in the Q&A box or else in the chat below. So, right, let's get into it. My first question is to you, Shannon. A practice hits 2 million in revenue and the owner's take home drops. What does that gap usually reveal about how the business is actually structured? Over
So,
to you, Shannon.
yeah. So if we're talking about, that it's grown to 2 million, I'm assuming that we've reached 2 million. That usually hits a point where you're growing, your operations are growing, and more revenue is coming in the door, but not all revenue is created equal. And this is where people get tripped up. So what could be what I call like false, like a false belief of growth is when you're bringing in a lot of revenue in low margin services, for example, injectables. So if your injectables revenue is growing, but your laser treatments aren't, your microneedling isn't, your other beauty treatments aren't, this could be weighing down the margin because typically those have a lower margin. And by margin, I mean how much you take home on every service because you're spending half of that revenue on vials of the product and another 20 to 25% on labor if you're managing that effectively. So now you've got about 25 cents on the dollar left over. So what ends up happening is if you don't know the service mix of that revenue, then you don't know how much you're really passing on to pay for the operating expenses, your front desk, accounting, legal, other expenses like that. And next thing you know, there's nothing left over to actually pay yourself with. So structurally, you have to engineer your service mix to be ideal to make a certain amount so that you can cover those overhead costs.
Right. So let's talk a little bit about that service mix and why does it get, under the radar? Why do you think that is? Why are we not looking at those service mixes and looking at how much they're contributing individually on a daily
Yeah, because I
basis?
believe we're managing our practices with reaction and not intention, right? We're reacting to the demand of what's coming in the door rather than exercising intention on what types of services we want to be promoting. And even further than that, I should add on that a lot of folks are also discounting these services on top of everything else or offering it with a membership. So now all the profit that you once had is gone. So the highest demand services sometimes have the least amount of profitability. So it can be tempting because there are so many people waiting to book an appointment for this service. But if you're filling up your books, which is the only real big constraint you have is your time. And if you're fully
Mm.
booked, you're busy, but you're also broke. It's called booked, busy, and broke. Then we have a service mix issue where you're not spending the right time on the right types of services that are bringing in that money.
Check. Thank you very much, Shannon, for opening us with a wonderful, comprehensive answer there. Now, Brooks, when a new device arrives with no utilization target set, which person in the practice is set to feel that financial pressure first, and when does it hit them?
Well, I would say first, rewind just a little bit. You really shouldn't bring a new device into the practice unless you have those utilization targets already in place. I mean, that's number one. You need to know demand. You need to know down to the person who's going to be buying those treatments before you even have your training day. And Shannon hit on a good point. Sometimes discounts take over and you get excited with something new and you want to discount those services early. And I treat discounts like a four-letter word. Don't use it. Don't use it around around me for sure. And a lot of times memberships like Shannon eat up some discount dollars. But that's just discounting at bulk. You're either discounting on a one-off or you're doing these memberships, which oftentimes aren't set up properly, and you're discounting at bulk. So number one, I would say rewind that question just a bit and just don't buy equipment until you have your utilization targets. You know who's going to buy. You really need to identify gaps in the practice that the new device can fill. Otherwise, you're not buying it for the right reasons. You need to start with the patient in mind and work backwards from there. So then once you have your delivery date set with the company when you're buying the equipment, then you need to have some of these packages pre-sold. So it's the one time where I would say it's okay to maybe discount. And I would say it's not really a discount, it's more of a trade, it's a barter. You're giving them the service for a lower price on a training day, but in return, you're doing it because it is a training day and you need to learn the equipment. You need to learn the ins and outs. You're going to go a little bit slower than you normally would in your normal clinical flow. So that's worth some value back to the patient, gets them a little bit of a better price break, but it gets you that utilization early, gets you comfortable, get your staff comfortable with how to sell the treatment. So I guess to answer your question directly, if you're doing everything properly, ideally, you're sharing revenue goals amongst the entire team that you have in the practice. Put a right on in the break room. Have your monthly goals for revenue. Everyone should feel that pressure equally, but ultimately, it's going to be the practice owner, or if you're bringing in Shannon as a fractional CFO, she would feel that right alongside with you. What I would say is that in order to overcome a lot of this, you really need to be
Mhm.
able to sell, and that means, sometimes um, practitioners, clinicians don't like the word selling, but you're in a business that's cash for service. So, inevitably, just by definition, you are selling. So it's imperative that you learn how to sell consultatively. You don't want to shove things down people's throats that they don't need, but it is important that you're selling them, guiding them to their ultimate decisions on how they're going to spend their money. And we call it sales, but really it's getting the best outcome for the patient. It just happens to have a price tag associated with it. So um, Facebook is littered with used equipment that people bought without having those utilization targets in place. So don't become one of those victims, because when you try to resell your equipment, you get pennies on the dollar.
Appreciate that, Brooks. We don't want pennies on the dollar. I just had a quick clarification over there with regards to when you are discounting and it's training day, do you make it known that it's still in the training phase to the client, or does that get swept under the rug?
I wouldn't sweep that under the rug. No, definitely make that clear. And usually there's in your practice, those people that will be a little bit more of the forward thinkers or want to be first, or they're the loudmouths, and that trade of giving them the discount for being there on the training day can actually help spread the word to their friends and family and the people that they network with. So no, be very transparent about that. I don't think there's any value in hiding that.
Appreciate that, Brooks. Now, Javier, across the markets you have operated in, what is the most consistent sign that a practice is confusing revenue activity with actual financial health?
Okay, very good question. And I think Shannon and Brooks mentioned something around this topic when the most consistent sign is when the owner of the clinic start to talk about revenue growth, number of procedures done, but we cannot take the cash in. So when they don't mention the cash effect of those revenue, those activities, that's the most consistent sign that BC is not the same as profitable. And when you are talking about that they are doing more procedures, the calendar is busy, the team is busy, but they cannot see this reflected into the bank account. That's the most significant signal that something is not correct. It's something related to Brock said, when you have a new procedure, maybe you are excited you want to come more bookings fast, and you start to discount. And when you start discount, you are busy, active, but you're not checking the profitability of that procedure. So number of procedures is not always equal to cash. And if the accounts are not monitoring the profit per procedure, the profit per seat, that's a wrong, can affect the cash generation. And at the end, when you are doing that, you are consuming the working capital instead to generate a new capital with those procedures.
And what would you recommend to practice owners, like a very simple weekly dashboard to expose that difference, to see the cash flow effect?
They should have a clear profitability per procedure, and related to what Shannon said, the service mix also impacting. If they are enthusiastic with one procedure, but it's not the more profitable, they have to train the team to convert more leads into the more profitable activities and not the ones that normally are demanded but lower margins. So they have to have a target of each service mix, the service mix as well. And also they should know what are the boundaries on which they can discount. It's normal to have discount, but they should monitor at which level they can go, how low they can go, and not to get excited to get more bookings, more patients, and to heavily discount for every procedure. So they need to have this discipline and this information in the whole team trained to see what are the rules of the game where they can move, discount a number of procedures.
Javier, I know it's not very easy to give a benchmark number on such things as those boundaries when it comes to discounting, but do you have an idea where you would say it's okay to discount to that level?
Depends on the procedure, because procedures can be low value, low ticket, and high ticket. So it depends on that. But normally more than 30% is a signal that for me they are heavily discounting. Also depends on the market, what are the inflation in the market, the revenue of the markets. Internationally, difficult to set a number, but more than 30% in a specific procedure is a wrong signal that we are too discounting too heavily.
Okay, appreciate that, Javier. Now, Andrew, when a practice must choose between investing in new patient acquisition and investing in converting the consultations already happening, how do you decide which constraint to address first?
Sure. Yeah, and I'm coming at this from the lens of the practices we've talked to as potential partners. We talked about 800 med spas a year. So we've talked to maybe 2,500 in my tenure here at Alpha, plus the 36 locations that are part of the Alpha platform, right? And that we've got extremely good data on. So we see what the market's doing, we see what we're doing, and we stack those up. Generally, like all of the high performing practices are not spending that much money on marketing as a percent of revenue. They're generally about 3.5% or below of all the top margin practices that we're seeing. So if you're spending above that benchmark in your, a year plus in, like you've had a little time to ramp up, you're probably falling out somewhere else. You're probably wasting money on new patient acquisition marketing, and you're probably falling out somewhere else. So yeah, you mentioned conversion, right? Conversion can mean converting a lead that comes in from marketing into an appointment. It can mean converting an appointment into a sale. It can mean converting a sale into a return sale, right? What we call like a rebooking or retention metric. So you have to be super tight on all of those. Anything that's leaking out of that, you're just right throwing money out the door. And then the last aspect of that is go through your patient list of who have come in, who have had great experiences. You've got hundreds or thousands of those patients, re-engage them, remarket to them, right? Everything we just talked about is basically free to improve. The most expensive patient you're going to go out and get is like a pay-per-click, right? Google ad, Meta ad, that sort of thing. So yeah, I mean, almost always to me, the answer is look at your conversion and sale and rebooking process and get that really dialed in before you start throwing more money at marketing.
Now, Andrew, in the poll earlier when we asked, there were a couple of people who had concerns with their consultation, specifically that conversion. Do you have any recommendations for our audience who had that issue?
Yeah, converting the console. I mean, yeah, you could do full day seminars on that certainly, and just scratch the surface. But our team members who do that better than anyone else, one, set a significant amount of time aside for it. A new patient consult is going to be an hour. They're going to give you a full, 18 plus month treatment plan. They're going to figure out your goals and they're going to address it. They're not just going to sell you 20 units of Botox and send you on your way, right? They're going to ask what's bringing you in, right? They're generally not going to point out problems. I'm going to say, hey, have you ever looked at, like, you've got this little line there? That's like wrecking people's self-confidence. And if they never notice that and you're a healthcare practitioner pointing out that line, now they're never going to not see it when they look in the mirror, right? So that's not what we do. But what's bothering you, right? What brings you in, and building off of that. And then it's, yeah, not being afraid to ask for the sale, right? I mean, even Shannon talked about that. And then I think Brooks did as well. But yeah, it's this idea of it is sales. You have to be comfortable getting into that with the patient, talking about money, and understanding that you're not necessarily there to save them or spend their money for them. Like, let them make that decision, right? And align it with their goals.
Appreciate that tip there, and Andrew, really appreciate it.
Mhm.
Now, Shannon, what is the minimum financial information an owner needs before a pricing increase is defensible and not just competitive?
So I love this question because I never worry about being defensible. I'm a fan of increasing prices across the board, pretty much, whether defensible or not. No, I think what you have to understand, and I actually want to back up to how do you know a price increase is the solution to your problem, is kind of how I want to answer that, which is what we try to do is diagnose where the constraint is, which is what you've mentioned. Where is our constraint above gross margin, meaning is it in our product costs or our direct labor? Or is our constraint in our operating overhead? Or is our constraint related to cash flow? And as we go through kind of this linear method of uncovering, I like a game of Clue in a set of financial statements. I'm trying to find the room, the murder weapon, and the murderer, right? I'm trying to figure out where is the prophet, who killed the prophet. And what we end up finding is a lot of times the margins are working. And for the most part, like in terms of cost control, labor control, everyone's utilized efficiently and the product is actually costed properly. We can't really negotiate that. Once we've realized that we've really created a utilization that's optimal, which is where I would probably start, is looking at provider utilization. And then you go into the material cost. Then you realize, I still don't like my ratio here. I still don't like my margins. Going back to service mix, but then also going to, okay, I think pricing is the next lever to pull. Because when you look at the math, your margin is your profit divided by your revenue. How do you create more revenue? More people buy from you. The people who bought from you spend more money with you. Or across the board, everyone pays more for the same thing, AKA a price increase. So one of these three things must happen for your top line to go up, period. So depending on what lever makes the most sense for you, usually I just talk to practice owners and I say, here are your three choices. Increase the price, get your existing customers to fulfill on the treatment plan you gave them and actually right? That's retention and lifetime value. Or we have to get new leads, new faces, new consults, and work on that conversion. So that's how I look at that constraint and say pricing becomes the lever to pull when the other two are working. Because I do think there's more money behind the other two, if I'm being honest.
Now, what about the med spa down the road increase their prices, so we got to increase ours?
Well, that's their business. We could, but I still would, instead of doing the cool exercise I saw someone else do on Instagram, I'm going to do what works for my body and what gets me the health goals that I want to, which you could say to your patients too, right? It's like, well, Susie got 50 units. It's like, okay, but that's not what you need. So we should talk about what your business actually needs and what the optimal flow is of your profit to figure out, hey, where do we need to adjust? And where is your time best spent in that process? Because if it's just increasing prices without addressing the other constraints, now you're making it even harder to sell patients and you haven't fixed the margin issue.
Check. Appreciate that, Shannon.
And hey, somebody has to be
Um,
the most expensive in the market too, right? They're not everybody
Yeah.
can be least expensive.
of course, somebody got to take the crown.
Mhm.
Now, Brooks, when a practice is weighing a major equipment lease against protecting operating cash, what does a credible break-even analysis actually need to include before that decision is approved?
Yeah, well, I think you definitely need to, again, going back to the other question that you asked me earlier, you definitely need to make sure that there's an unmet need in the practice that the equipment is fulfilling. So that's the most important part, that it's patient driven and that you're doing it for the right reasons. And secondly, when you go in to negotiate your equipment purchases and you're thinking about this break even analysis and what your monthly, for lack of a better term, your monthly nut's going to be, you need to think of it in terms of negotiating not just the price of the equipment with the vendor that's coming in to see you, but then also the terms of your lease can affect your payments, the length of the time that you're going to have the equipment under lease, how long your warranty is, what additional warranty you may have to pay in the future. So you have to take that into consideration. So what I would do before making a big purchase is call somebody like myself who's got some experience on negotiating these deals for 20 years and negotiate out all the details, all the fine print. Don't leave anything on the table, first of all. Make it as favorable for yourself as possible because quite frankly, it's a buyer's market right now and you can leverage that to your advantage. And I say that as someone who still sells some equipment, and shows people how to purchase things that do fill those gaps in their practice. But then I think cost of ownership is inclusive of, not only the lease payment, but also ancillary procedure costs. So if there are other things that are required to use during the procedure that aren't included from the company, you need to factor that in. You've got obviously your employee costs, and that's going to range depending upon the level of complexity of the device requirements. So if you have someone who's either a physician or nurse practitioner or a PA versus your esthetician or your RN. That can lead to varying employee costs, commissions that you pay, for someone who sells the device or the procedure. You got to factor that in, and then just net overhead in general. You got to factor that. So when you're thinking about your monthly payment on that device, it's not just that monthly payment. There's a lot more that goes into it. And so think of it like an employee. You want to keep that employee busy and productive and making money for the practice.
Brooks, that was a lot of metrics to look at when we're looking at
Is that a lot of words?
just, weighing. Yeah, I'm just curious, how do you stay on top of it? How would you recommend like practice owners who are super busy? Perhaps it's a solo injector, who is also the owner operator. How would you recommend them to really tackle that aspect?
So the device people, me being one of them for many, many years, do this every day. And so there's as a practice owner, being on the other side of the desk, you're not doing it every day. Get some help. Have somebody else, get another set of eyeballs on it for you. Take your time with it. There's a lot of false sense of urgency that's delivered. And oftentimes practice owners especially buy into that. And I would encourage everybody to take a deep breath, evaluate the financial side of it, also evaluate the demand side of it. There's a lot of good equipment that can make you a lot of money if you do it correctly. If you really put the right procedures in the right practice at the right time, at the right price, with the right people around you with the business, man, you can really make a lot of money because you're making a lot of people happy. But if any of those components are missing, then you're going to have $100,000 doorstop, and that's where it gets to be very painful because those payments don't stop when you decide that it's no fun for you anymore.
Appreciate that, Brooks. And I think that's a great segue into a wonderful resource that I have to share with our attendees here, getting that help, right? So earlier tonight, I asked what is keeping your practice busy but financially flat? A good number of you said that the right patients are not consistently finding or choosing you. So hold on to that answer because the next few minutes are about exactly just that. Now, we've spent the first half hour tonight underneath the top line number, margin versus rev, device utilization, and all of that assumes a steady flow of the right patients arriving in the first place. While we're talking right now, someone in your market is searching for a med spa near them, trusted injector, or a treatment your practice already performs well. The question is whether your practice shows up in that search and whether what they find give them enough confidence to choose you. And that is where Echo Marketing comes in. For over 15 years, Echo has helped healthcare practices across USA, Canada, and the UK strengthen their visibility, their websites, and their authority so that the right patients can find and trust them. The expertise our panelists have been unpacking tonight truly deserves to be found. So here's what is available to you. If you own or run a practice and tonight has named a constraint that you cannot yet clearly see in your own numbers, Equa is offering a complimentary 60-minute practice growth strategy meeting. Their team will show you where you currently stand against other practices in your area for the treatments you are actually trying to fill, walk through the gaps in your visibility and patient journey, and help you leave with a clear set of priorities for your next phase of growth. You can go ahead and scan that QR code on your screen or click the link our team has placed in the chat. It takes under a minute to reserve. There is no cost, no obligation, and the only thing you are investing in is an hour to look at the practice through a sharper growth lens. So go ahead and reserve your spot now. I'll give you a few seconds and then we will come straight back to the panel. Right then. Do want to segue into a bit of a Ask Me Anything segment here. We will tackle a couple of questions that we have already received here before we continue on with the main discussion. Because I saw a question from one of our audience members here, Abena. Abena has asked us, how do you train providers to understand that the sales and the moving patients to more profitable services can be good for both the patient and the practice? We have providers that are always trying to save the patient money, but they affect the results and the practice's bottom line. This is free for all. I think we can get it started with Brooks.
Okay, sure. So I
Since
think
you had a couple of thoughts. Yeah.
yeah. So thanks for the question. First of all, I think your typical provider is allergic to the word of sales, and they have to get over that allergy, first of all. So, the first thing to think of is think of the patient and the end goal that the patient has in mind first. If a patient's coming in and they want to get in and out with just a Botox injection, they anybody who needs a Botox injection is already of a certain age, so they've already accumulated a certain amount of photo damage. They've already accumulated a number of years under their skin, so to speak. So they have other things going on other than just a wrinkle. So the wrinkle is what shows maybe their underlying things that covered as well or discussed. Patient through what they need and then showing them how to get what they need at the end and building out. I think Andrew mentioned that their practices put together an 18-month treatment plan. That's very commendable. If you can get a year, that's wonderful. So to get 18 months is very commendable. That treatment plan then can also include a financial plan. So the selling process is simply guiding the patient to what their ultimate outcome needs to be and showing them the financial way to get there. And so uh, learning how to sell consultatively is the key to doing that. You don't have to sell and be sleazy. You got to remove the that allergy, as I call it, um, or that predisposition that sales is somehow a negative connotation. You need to remove that and just realize that you're just helping somebody get what they want. Don, you're
You're
mute.
mute. Don, you're mute. No,
Don, you're on mute.
you're on mute, Don.
My apologies there. So yeah, Javier, I would love to get your thoughts on this matter because you have worked in international markets. What are you seeing, in terms of training and how to change that mindset from, what making the decision for the patient instead of making the decision for the patient, how can we change our provider's mindset?
Hmm. I think I can complement to Brooks if we present a plan to the patient, and also we need to. I understand the questions, but I think working for providers, I think if we have a happy practice, profitable practice, they will buy more. And I'm not totally agree that we always, or the providers always think in terms of patient benefits, sacrificing the practice. I think it's more affected by the competition. But having said that, I think one of the ways to sit to do a plan, longer plan, and not only 1 month per month or one purchase by purchase. If you work with the provider and to show mid long-term plan, agreeing in volumes and proceed that you can do during the year in the plan together, this can help both to secure the profit of the practice and to be competitive prices to patient as well. So sit with the provider, plan together, not do it one by one, case by case, purchase by purchase. So you need to do a mid and long-term plan.
Okay. Appreciate that, Javier. Now, I have a very tricky question. It's almost like a case study that one of our registrants have put forth. I'm actually going to copy this into the chat just in case if anyone wants to have a better look at it. I'll say it live. So, one of our registrants have asked if I have a separate C corporation already established for other businesses I work with, should I take a profit each month and write a management fee check to that C corp? Say $20,000 profit instead of taking that home as a distribution, writing it to the C Corp. Because in theory, tax burden may go from 37% to 21%. Is this the correct way of thinking about this? Shannon, I'm going to shoot this question right at you.
I like the way they're thinking. It's going to be an it depends thing, but I want it to be helpful. So here's one thing you have to keep in mind though. If here's what you have to look at when it comes to how to structure and how to direct profit and things like that. You guys have all seen these things on the internet that's like the straws that are all mixed up and it's like which one is he drinking out of or what. So I want you to think of it like that. Like profit flows through these different straws and it's like what bucket do you want it to land in? Like, what does it make sense in terms of do you want it landing in a C corporation where it's taxed at a federal 21%, but if it stays in the bank account, that's the factor. And that means you can't distribute it. If you distribute it, it's taxed again at your personal tax rate. So you have to be careful with that. That's why you have to pay yourself a salary and do things I don't have time to explain. But you would have to be mindful of, do I need this money? Is this funding my lifestyle? In which case, maybe that doesn't make sense. If you have to tie up all your money, you're not really getting a tax benefit out of it. You also have to look at, am I planning on taking investors in the future, like Alpha? Are you planning on you know, what is the future? What is your treatment plan for your business? What are your goals, right? So when we look at either a tax situation or the financials, we treat it just like you guys do with your patients. We say, okay, what are your end goals here? Where do you want to take this? Because that will direct the route that we take with it. Now, I like the way they're thinking. I love a multi-entity strategy. I really do. You may think it adds complexity, but I do like the idea of having certain functions separated, either both operationally and financially. But here's the thing, if you're going to do something with multi-entity, you have got to keep it clean. So you can't keep your personal stuff in there. You got to keep the stuff that relates to entity A and entity A, B and B, and you got to keep it organized. So I would say if you believe you can keep stuff organized, you can take advantage of a ton of really cool strategies that we can go into on a more personalized basis.
Appreciate that, Shannon. Andrew, I just want to get your perspective from, your time as an investment banker. What do you think about this question? How would you approach it from an investor's perspective?
Yeah, I think Shannon nailed it. She's the only CPA on this panel. This is very much up her alley. Talk to your CPA about it. We don't know your situation, but yeah, I mean, generally, if you feel like you have to do this, you might have your original entity set up incorrectly too. Uh, yeah, writing a management check to a C corp has pitfalls, as Shannon alluded to. So yeah, make sure you understand what you're doing before you try to save on taxes and end up costing yourself a whole bunch of money in the process.
Yeah, have your
Appreciate.
CPA help you architect the way that that should flow because that will ultimately be the right answer. We do things like this all the time, and I think it makes a ton of sense to take advantage of stuff like this, even going the other way, operating from a C corp and doing a management co. But I will say this, if you're making, I have to do one practical tip. If you're making more than 50K in profit, at least be having the conversation about the S corp election. Just have the conversation with your CPA. It may not be the fit for you at times, but that should be a conversation when you're crossing 50,000 in net profit.
Okay. Appreciate the benchmark there as well, Shannon. Thank you for everyone who submitted those questions. This is why I love our expert panels. It's like we get a complimentary board of advisors for the hour that you can just, put your questions in and see what comes out. It's amazing. Thank you so much for our panelists as well for answering that impromptu. Now, Javier, walk us through a specific moment a consultation ends without a booking. Who owns that next step, and what does a structured recovery protocol look like at that handoff?
Perfect. Excellent question, Dan. In fact, I work in that part of the business when I introduce new products, especially new category creation. I created programs for my team and professional education to train practices on that topic. First, you will be surprised that normally practices are not tracking the leads from the beginning to the patient journey, from the lead to consultation or procedure. So the first thing is to track the conversion of those steps from lead to consultation to practice. And then it's important to measure that drop if there are no's, why this is no, and then to designate someone in the team to do the follow-up. When you say my team will do the follow-up, means nobody will do the follow-up. So it's important to train one person, designate the person to do the proper follow-up. That's something I see in every country across the board. The other thing is what type of no you got. What is the objection? Is it price objection? Is it fear or is it clinical? So you have to have prepared some answers to provide in the follow-up. I recommend the follow-up after 48 hours minimum, and to have those objections or answers to those objections already prepared and validated by the team. Is it finance, or medical with the doctor in charge? And do that specifically and to track the percentage and also to track how many of those that you say no, how many you recovered. So you know what is the percentage, how much you can improve, and you are doing a good job. So normally I say that when they are not converting those leads, it's not a patient loss, it's a patient that was not properly managed. Because if you are trained to manage the objections, probably you can convert those leads.
I appreciate that. Patient, not lost, but patient improperly managed. Now,
Sure.
I was just curious, the designated person to follow up, is that one person or else are we taking turns here?
Depends of the organization. I saw very good practices to have one person very well trained by procedure. If you have different procedures, very complex, normally they designate one person for each procedure, so they are the expert to manage all the objections. It's a small practices, maybe one person can be trained in different procedures, but depends on the size of the structure of the practice. But normally should be someone that knows how to do it and when to do it.
That's key. Now, Andrew, what number do you feel indicates that labor costs are getting too high, and how do you address that?
Yeah. So when we're looking at practices, when we look at our own practices, we look at it on a percent of revenue basis, right? To try to bring some apples to apples benchmarking. And for us, where we want to see all of labor, so that's what you're paying your front desk staff, what you're paying your providers, and if you're running like a business that you own, what you're paying yourself, if you're paying yourself a fair market wage, right? Because as the owner, you can pay yourself $1, you can pay yourself $1 million, right? It's really up to you. So take a look at if you were to pay yourself, let's say, if you're an injector, as the doing lasers devices, like 20% of your collections is a good benchmark. So if you take all of that, put it together, you want to be in that 25 to 30% of revenue range on your gross pay to everyone. If you're adding in benefits and you're adding in taxes and things like that, maybe you're inching closer to 35%. But if you're paying, your team, yourself at a fair market wage, everything all in more than 35%, you're probably getting out of whack. And you're going to start to see this problem we're talking about for the podcast, which is that there's just not much left over for the bottom line at the end of the day. Now, on the flip side, if you're paying way below that, sometimes we have practice come to us and say, I'm only paying my team 10% of collections. Isn't that awesome? Well, maybe for a month or a year, you could look at it that way, but we're in a very competitive industry. Everyone talks. Patients are so tied in with their providers via Instagram, right? Like my wife follows her injector on Instagram. She does not follow her dentist. She does not follow her primary care physician, right? If her injector goes somewhere, she's going to follow. So if you're paying too low, you're risking losing that provider as well. So yeah, I would say that that's the benchmark. And then keep in mind too, if that's like your best situation, like in the best month, you're 35%, you're probably paying a little bit too much because we're all going to face team going out on PTO, maternity leave, right? I mean, which is phenomenal for the person, and you want to provide them that support, but like maternity leave is just a huge reality of this business that you have to plan for. So just making sure that you're able to kind of survive those times where you're paying out, and maybe not seeing the production.
Appreciate that, Andrew. And absolutely, maternity leave in the aesthetic industry is a huge part of it because over 90% of our providers and laborers in the aesthetic industry are female. So there's that percentage right there. Now, Shannon, describe the monthly financial meeting that actually changes a decision. Who is in the room? What is on the screen? And what's get documented before it ends?
So I love monthly financial review meetings, but what a lot of folks do is if they have a bookkeeper, this turns into a book report of the P&L, going down the line, reviewing performance and saying this was up or down from last month, good or bad, but never really giving context on the goals and never really kind of giving you decision-making capability from it. So a lot of it is accountants speaking to business owners as though they understand accounting. And so what we try to do is we create the entrepreneurial conversation around the monthly financial meeting brings leadership, accountability, decision making. So, where we come in and say, we already have the agenda on the decisions that have to be made if we're doing it right. We already come to the meeting knowing we have to make these 3 or 4 decisions on this call. And so, you have people in the room who are at the executive level who can also get exposure to this information because we don't want to overexpose our financial information. We have to protect it, but we need to know what the key drivers are. We need to know where that constraint is and what will help unlock it. What are the different levers we need to explore? Let's have a conversation. versus going through the P&L and trying to find it together. That's our job as CFO. So we'll come in and we'll find where the problem is and say, here's what we found, and here's what we think you need to do about it and get the reaction, right? You either need to increase prices or we need to do X, Y, and Z. And we talk to the business owner about what's practical, what makes sense for them right now, what they can operationalize. And we have that executive level decision making. In order to have that meeting, you're presenting on the screen a few key metrics that are important for the decision, not the entire P&L or the entire balance sheet. That's for consumption before the meeting. That should be sent to you a few business days prior, giving you enough time to read it if you can. And you want that data to be timely after a month end, so you have plenty of time to review it. I know a lot of practices that I come into that get their data quarterly. That is way too long to wait. That's like getting your first test in your semester at school the week before finals. So, like, you don't know how well you're doing until you're almost at the end and getting a grade. You have no time to implement feedback. You have no time to understand what's going wrong and to revisit the syllabus. So, what we want to do is create that timeliness of data so that it's super clear what you need to make your decisions with.
Timeliness of data. I mean, again, it's a lot, I feel like, for our practice owners, but hey, that's why there are amazing people here on the panel who are good at what they do, and you can get help as such. Now, Brooks, what is the single leading indicator you would track weekly to know whether a practice's revenue per provider hour is moving in the right direction?
Well, before I answer that, Don, I just want to say I took
Mm,
notes on everybody else's answers, and my answer on this actually is going to pull from some of the things that Javier said, and some of the things that Shannon just said, and of course, getting back to Andrew's treatment planning. I think that's what I love about these panel discussions is that you get you get so much brain power together, and I'm taking notes as much as anybody else that's out there. So I think number one, the revenue per provider per hour, that's going to be a lagging indicator typically. And what I mean by that is that there's a whole bunch of things that come in first before you're going to get to that number. And sometimes, especially if you're making changes in the practice, you may not see that show up in the bottom line right away. So the first thing to look for, I think, evaluate your intake process, especially if you're having a hard time. The question earlier was about, having a hard time getting providers to sell. If you're having a hard time getting providers to sell, make it easy on them. You already know what the roadblocks are, so have a good intake process. Once your intake is taken care of and it exposes some problems that the patients are having, then focus in on doing a better consult. Then, once you've done a better consult and you're looking at not just, hey, the patient is self-diagnosing and self-prescribing themselves a Botox injection, then we go deeper. Okay, what else are they coming in here for? What else are they bothered by? What does that mean? If they're saying they have a wrinkle, again, like I mentioned before, if they say they have a wrinkle, there's usually 3 or 4 other things that are going right alongside that, and that needs to be brought up to the patient as well. There's at-home things that they can take, with them once they leave to maintain their results or to even enhance the results that they get in the practice. So retail needs to be something that's considered as well. And then the revenue per provider per hour, that'll just naturally follow if you do all of those other things correctly. The revenue per provider is an indication of how well you're treating the patient and how well you're meeting the needs of the patients. And so the better job that you do meeting the needs of the patients and exposing and what they want and getting it out of them, what their ultimate goals are, and then putting them on that treatment plan, the rest will fall into place. So getting back to Javier's point about the patient was improperly managed, I mean, that's probably 80% of it right there is managing the patient through that cycle. And then the revenue will follow. It's just a natural following metric. To Shannon's point, though, you don't want to do this on a monthly basis or a quarterly basis. You really should have weekly reviews on this so that and you're tracking these metrics. And then even daily huddles. The daily huddle can be a short 2-3 minute management meeting out to the providers and the employees. Hey, we've got this group of patients coming in today. Let's make sure that we're delivering the results that they want and that we're setting them up on the treatment plan that gives them the success that they're asking us for. Let's do our job the best. It will lead to obviously revenue, but the ultimate outcome is what the patient needs and wants. The money will
right.
follow.
Appreciate that, Brooks. And Shannon, thank you so much for that information tidbit. Mentioned the lagging indicator, the difference, so that everything that Brooks said. Uh, Now, Javier, what signals tells you the operational structures that would hold up partner scrutiny before growth is pursued?
Hmm. Yes, a good question as well. I think the signal I look is when we talk about business with the practice and all the answers are coming from the owner only. That's a signal that there is no structure and everything depends on this person. And when we are looking at something different, if you see that they have numbers clean and easy to understand, that's a structure. When they have commercial policies, at least in a simple way, but at least everybody knows what we discuss, discount and everything. Something that Brooks and Sharon mentioned as well, some KPI is important. My favorite is every Brooks, all the patient journey. If you track the patient journey, today with the digital tools existing, it's very easy to track this information, easier than ever. When you have all this information, I think these are signals that the business is well structured and not depends on the memory, the impressions, and the opinions of one person, like the owner.
Hmm. Now, why is that a problem? Like the dependency on the owner, especially when it comes to even this financial knowledge.
Yeah, what I see in life is this practice has been built one person. The owner is the dream of one person. It's difficult for this person if the practice growing to delegate and to incorporate new tools because he was managing from the beginning with his own way of working, his own ideas, and difficult to share this information and this vision with the rest. Many owners think that I build it this way. I know how to manage. I can do it for myself, and I keep everything with me and no need to structure. So there is a kind of fear of to the change and also to delegate, to lose control.
Okay. And that becomes a bottleneck for the whole practice and just,
Yeah,
burns out the owner as well.
it can be the painful part of the success. Someone grew the business. They say I did it this way for many years, so I'm very successful. Why I should change? So there's a mindset. That we need to work with that mindset.
That's a flatline mindset, and that's the exact one which we want to go against, right? Absolutely. So now, Andrew, after a platform partnership closes, what is the first number that confirms whether practice's growth ceiling was a marketing problem or a structural one?
Yeah, I think if it's a structural problem, the main thing that we haven't talked about here is utilization, right? So whether you're looking at provider utilization or facility utilization, that's something we're digging into. Again, you can be striving, like obviously too low is an issue. You're paying for rent and people's time to sit around and not be productive. But people also frequently strive for too high of utilization. They try to get as close to 100%, and it's just not feasible. And it means that it's one thing we see all the time is you're actually booking, patients have to wait too long to get in because the time slots they want are filled up. And so if they want to get in, it's 3, 4, 5, 6 weeks. And like I think maybe Shannon said at the beginning, we're in a cash pay business here and there's competition. And so they're going to go down the street if they have to wait that long. So, yeah, I mean, that's one of the structural issues that we see that you can solve for. Stop trying to strive for 100%, build in the times where patients want to be there, build in availability there. But other than that, yeah, it's probably a marketing or conversion problem. If you're nailing that, look to those other ways. And I know we've given you some strategies for how to fix that.
Right. Now, Andrew, during your consultations with these high performer practices, what's a good utilization rate that you saw um, across the board?
Yeah,
If
once you're
not,
getting to about 80% of a provider's available time, that's usually when you want to start thinking about hiring a new one. And 80% can mean different. Some providers run 3 rooms at a time, right? We have that. Some providers are only comfortable running one. So utilization, kind of that denominator can vary a lot, but yeah, 80% is a good goal.
Appreciate that, Andrew. Now we have arrived at the top of the hour here. I want to ask each of our panelists for a 45-second golden rule for turning a busy aesthetic practice into a more profitable and structural sound business. Shannon, start us off. What's our golden rule here?
I would say don't ignore the numbers. They're telling you the truth. One thing we didn't hit on that I'll add into this segment is you should really know three core things about your practice from a financial lens. One is your gross margin by treatment, which we have discussed. The other is your lifetime value of a patient. So they're basically the gross profit of their treatment plan. So how much you plan on generating from that patient in the time that they're with you, meaning that's going to be fed by retention and pricing and the treatment plan itself and service mix. It's a great combination of those things to figure out if you're really profitable. And then lastly, I want to insert, you have got to be looking at your cash flow, not just your profitability. So your profit will tell you how much money you have to now pay all those obligations to the device people and all the loans and all the stuff that you bought with the fancy new equipment. So what people don't realize is a lot of that profit leaks out through paying yourself, through distributions, and also through your loan payments. And so your margin, your goals should match whatever's necessary to make sure you're getting what you want after all of that is paid off.
Now, Brooks, how about you?
I would say every practice needs to learn how to sell consultatively. And that doesn't mean just the provider. That means everybody in the practice needs to go through some training. And training is like taking a shower. It wears off after a while. So you got to stay on top of it. And again, make selling not sleazy, make it very consultative, lead the patients to a decision that helps. And think about combination therapies. There's no one treatment that's good for everybody that gets them in and out. If they have one thing going on, they usually have more. So and learn how to communicate that and sell that to the patient, and the patients will be happier, and you'll be happier.
Love that. Javier,
Yeah, I will complement what Shannon said. Cash is king, so look at the cash, not only the profit. But at the end of the day, revenue is P times Q, price times quantity. If you are super efficient, your prices are right, look for the Q, how to bring more patients to your practice, and be vigilant to incorporate something new, any innovation, with financial discipline, of course. But this can be a solution. So cash and P times Q can help you to be profitable.
okay. Andrew,
Yeah, totally agree with Shannon. Know your numbers, but then lead from them. Be a leader. You run your practice. If you're, the theme of this is busy isn't always profitable, right? And if you've got the revenue and it's not falling to the bottom line, there's tough decisions that have to be made. Know what they are, be decisive, make them, and they're going to be the best decisions that you ever made when you come back out the other side. But yeah, if you've done the hard part, you've got the revenue. Now it's time to address where that's going and make the hard decisions.
appreciate that, Andrew. Thank you very much, panelists, for those wonderful key takeaways. Now, as we wrap up, I do want to remind everyone in our audience that you have a fantastic resource at your disposal in the chat one last time, or else the QR code on your screen. If the patients, your ideal patients in your area, are searching for the treatments you provide, you're excited about, make sure you're the one that they find, like, and choose. Go ahead and book that consultation, completely complimentary meeting with Echo Marketing to figure out your next steps in your growth. That being said, we have arrived at the end game here. I would like to take a moment to thank our panelists, Shannon, Andrew, Javier, Brooks. Thank you so much for really sharing your insights and your experience so unselfishly with our audience here. And of course, to our audience members, thank you so much for investing this hour in your practice's success. As you exit this webinar, a quick feedback survey will pop up. Please do take a couple of, it takes under a minute to fill it out. Let us know how we did, what we can do better so that we can bring you even better events next time around. With that being said, panelists, do stay on the line for 2 minutes for a quick live debrief. And to everyone else, thank you so much. It has been my pleasure and privilege to host this on behalf of Business of Aesthetics. Dan and Disha signing off. Until next time, take care, everyone. Bye-bye.